Hello everyone, this is Steve Gorin, and thank you for attending today's webinar, Planning under the Proposed Regulations under IRC Sections 199A and 643F. Before we begin, we want to cover a few housekeeping items. At the bottom of your screen are multiple application widgets that you can use. This is just like an economics course when we talk about making widgets. All of the widgets are resizable, movable, so feel free to move them around to get the most out of your desktop space. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. If you have any questions during the webcast, you can submit them through the Q&A widget. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. Please know we do capture all questions. A copy of today's slide deck is available in the resource list. We encourage you to download any resources or links you may find useful. So in addition to the slide deck, you'll see some supporting materials from my newsletter and also ACTEX comments on the proposed regulations. For the best viewing experience, we recommend using a wired internet connection and closing any programs or browser sessions running in the background that could cause issues. Webinars are bandwidth intensive, so closing any unnecessary browser tabs will help conserve your bandwidth. Some networks cause slides to advance more slowly than others. If your slides are behind, pushing F5 on your keyboard will refresh the page. So that's F5 and not just the F key. You can find additional answers to some common technical issues located in the Help widget at the bottom of your screen. An on-demand version of the webcast will be available approximately 30 minutes after the webcast, which is a great improvement of what we used to be, and can be accessed during the same audience link that was sent to you earlier. This webinar is CLE accredited in California and Illinois for 1.5 hours of general CLE credit, and in Missouri for 1.8 hours of general CLE credit. So, off to the races we go. On to the overview. Okay. So, I'm going to talk today about the Code Section 199A deduction. We'll talk about the wage and UBIA limitations, UBIA being the original cost of property that you purchase. And we're going to include basis step-up issues and changing business structure. We're also going to talk about the significance of what they call relevant pass-through entities, or RPEs, and aggregation. And we'll talk about specified service trader business limits, as well as the proposed regulations vicious attack on trusts. So this is really going to be about how the proposed regulations change or enhance our understanding of Code Section 199A and the multiple trust rules. So I'm not going to try to get into all of the planning ideas, which would take me a lot longer than 90 minutes, but we'll just get into some key ones. So now on to slide 4. This is just a background about the 199A deduction for basically up to 20% of qualified business income can be deducted that comes out of your pass-through entities. And a pass-through entity would be a partnership interest, S corporation stock, or sole proprietorship. So that would include an LLC, whether it's taxed as a disregarded entity or an S corp or a partnership. And then you'll see that at the bottom of the slide we have a link to where the proposed regulations in the preamble are. And the proposed regulations and preamble page also has comments on it. Now, some of the comments that were sent into the IRS were very helpful. And other comments sent to the IRS were along the lines of, "Get out of my face, you bleeping idiots." Hopefully they won't respond to those comments. Going on to slide 5, that's just kind of the overall calculation of the QBI deduction, but we're going to kind of skip through that and go into slide 6. So for each separate trade or business, which is really key. What is a separate trader business? We're going to focus on this as we kind of go through the first part of this. So for each separate trader business, you have the lesser of 20% of the taxpayer's qualified business income with respect to the qualified trader business, or the wage and limitations that relate to that particular qualified trader business. And the wage and the UBIA limitations we're about to go through do not apply if taxable income is below certain thresholds. So on to the next slide. Our first code word is wages. So please record that, because when you ask for your CLE credit, you're going to have to write down the word wages as our first code word. On to slide 7. So for each separate trader business, this wage limitation is the greater of 50% of the W-2 wages from that business, or the sum of 25% of W-2 wages from that business, and 2.5% of the unadjusted basis immediately after acquisition of the qualified property. So, basically, originally this was going to be just 50% of W-2 wages, and the real estate industry said, hey, this is a Tax Cut and Jobs Act, and the tax cut comes first. So for those of us who don't care about providing jobs, give us a break anyway if we have depreciable property. So we have that second limitation in there. And so this unadjusted basis immediately after acquisition, so that's just the original cost of the property. And so Congress couldn't just say original cost in the statute. They had to come up with a fancy term, UBIA. For those of you who watched the movie Die Hard, UBIA is not to be confused with Yippee-ki-yay. However, the words that immediately follow Yippee-ki-yay are my feeling about the complexity of the new law. So the proposed regulations refer to the 50% of W-2 wages as the wage limitation, and the sum of 25% of the W-2 wages and 2.5% of the UBIA as the UBIA limitation. So going on to slide 8, W-2 wages. The proposed regulations don't have any bad surprises, but they do have a good potential surprise, and that is that if you have leased employees, those can count. So if your business hires some outside payroll service and you lease the employees from them, but they're still really your employees in substance, they're just not your employees in name because of the leasing arrangement. So then you can count their wages. So some of the issues that go with that is that under kind of normal common law provisions, they will still need to be your employees. So you need to supervise them. You're still determining their job categories. You're still reviewing their performance. You're still deciding whether they continue to be employed. So all of those things where you exercise control over employees, those still need to be in place. And so it can't really just be somebody who you're borrowing from somebody else and it's really their employee and they're still in charge of everything they do. You have to exercise control over them. And the deal is that you can't take credit for the wages and the employee leasing company take credit for the wages. Only one of you can take credit for the wages. And of course, that should be you if you're the employer. Now, also notice that using an independent contractor still does not help. So you're not going to get wages from using an independent contractor. Going on to slide 9. So depreciable property, I have the rules from that of what's qualifying depreciable property, and I'm not going to go through that again. I did that back in my webinar back at the end of January when I went through the rules. but you will notice that you can use depreciable depreciable property, the UBIA, only during its depreciable period. And we're going to talk about the depreciable period in a little bit. So let's go on to slide 10. So again, the UBIA, the original cost, the proposed regulations clarified that you ignore Code Section 179 expensing. So there had been some concern that because it's the unadjusted basis, that there might not have been basis because Code Section 179 expenses your cost rather than capitalizing your cost. Normally, you would think that you have to capitalize the cost in order to have basis. That would be kind of the normal kind of common sense rules. But the proposed regulations gave us a break and said that you can count the basis even if you've expensed it under Code Section 179. Okay, let's go on to slide 11. So the proposed regulations have some nasty surprises for us here. When you move property to a new taxable entity in a non-taxable exchange, you get the worst of both worlds. Let me take a step back before I talk about these rules and just say how this applies for normal income tax purposes. So let's suppose that you take the property you have and you contribute it to a partnership, or you contribute it to an S corporation. That partnership or S corporation will take that property generally with the same basis that it had before, the same holding period it had before, the same depreciation schedule it had before. Everything about that property stays the same. It's just reported on some new owner's tax return. So common sense would tell us that your UBIA would also tax just like everything else. If you bought equipment for $100,000 and you wrote it off and you contributed to the new entity, you should have that same $100,000 original cost because everything is tacking. But the proposed regulations said, no, that's not how it works. You have to consider the unadjusted basis at the time you contribute to your entity. So suppose you bought the equipment for $100,000, you were using it in your own business, and you decided to form a partnership, and you contributed to the partnership for use in that partnership. Well, if you wrote off that the entire cost of that $100,000 equipment, because you could have written it off in year one under 179 or as the bonus depreciation, you could have written the whole thing off. If you kept it by yourself, you would have continued to use that $100,000 UBIA, phrase your UBIA. But if you put it into the partnership, it's going to get cut down to zero because you had fully depreciated it. So you lose UBIA when you contribute property to a corporation or a partnership. And to add insult to injury, not only do you lose UBIA, but you still have to continue with your original depreciation period. So you don't even get to start over with your depreciation. So not only do they nail you with reduced or eliminated UBIA, they also make you keep the same original period. So the tax laws really should say you keep the original period and you keep the original UBIA. And that's what ACTEC suggested. Now, there is a potential workaround on this, and that is when you form your business, don't put the entity into, don't put the property into the business. So what you need to do instead is keep that property out of the business and lease it to the new entity. potentially. And then you need to think about how that's going to work in terms of, okay, now you have some equipment rental income. So that equipment rental income is going to be reducing the qualified business income of that partnership, okay? Because that partnership is going to have a deduction for that rental expense, so that's going to reduce its qualified business income. And so now you're going to have this rental income. Now, equipment rental generally is considered to be a trade or business. You really don't have to do about anything to make it be considered to be a trade or business. So rental real estate, we do have an issue as to whether that's a trade or business, but equipment rental, we really don't. But now let's consider, so you have this piece of equipment, and you're getting equipment rental, and we know that that's qualified business income, but what are you going to be able to deduct? Because you're going to have the wage limitation and the UBIA limitation that come into play. So you've preserved your UBIA limitation, but is that going to be enough to offset or not to offset, but to allow you to take the full deduction? So if you're below the taxable income thresholds, which are $315,000 for married filing jointly, and $157,500 for everybody else, including trust, then you don't really have to worry about UBIA anyway, and so you wouldn't be pulling this planning deal. But if you are above those and you care about UBIA, so you're going to think about how that's going to affect your equipment rental. And so are you going to have enough UBIA in wages as an equipment landlord, so to speak, equipment lessor, to be able to take the deduction? And you might or might not. And then it is possible that you might be able to aggregate the property. You might aggregate your equipment rental with your business activity that you come from the partnership, and then combine your qualified business income and your wages and your UBIA. But you may or may not qualify for aggregation. So we're going to cover that when we go through aggregation. Okay, going on to slide 12. Here's another thing. If a person dies holding property, and that person leaves that property directly to a beneficiary, then that property will get, of course, the full basis step up, and the UBIA will also change to the value on the date of death. Now, the proposed regulations talk about sending it to an heir, and of course, anybody who has a good estate plan is going to be sending it to a beneficiary of their trust or their will. And so the ACTEC comments suggested that the government clean up that language and not just use the word heir, but anybody who receives it by reason of surviving the decedent. So anybody who owns 100%, they're going to get the full basis step up for income tax purposes as well as for the UBIA in computing your deduction for qualified business income. So let's think about other assets that might pass by reason of death. So suppose you have an S-corp and your stock passes by reason of death. So there's a new basis, so there's a basis step up on it when your beneficiaries receive it. But just because the S-corp passes doesn't mean that the basis of the S-corp's assets changes. Only the basis of the S-corp stock changes. The basis of the S-corp's assets, the inside basis, does not change. That's just a problem inherent in S-corps. So let's suppose you have a partnership, though, If you have a partnership, you can make a special election called a Code Section 754 election, and the 754 election allows you to get an inside basis step up. So let's suppose that you had a zero basis in your partnership interest, and when you die, the partnership interest is worth $100,000. So then, and there's a 754 election in place, so then your beneficiaries can take that $100,000 basis step up in your partnership interest, and they can apply that to their share of the partnership's assets. And then you can take the depreciation deductions for their share of the partnership's assets. Now, is this new basis going to give you UBIA? The government said, and the proposed regs said, no, because we're concerned about duplication. And at first I kind of scratched my head and was like, well, what in the world are they concerned about? But if I'm composing comments to the IRS and I want to ask them to do something, I better very well understand their concerns. So I thought and finally figured it out. So here's an example, this third bullet point. Let's suppose the original purchase price and current value of your share of the property is $100,000, and the accumulated depreciation was $40,000. So therefore, the property has a basis of only $60,000. Now, what happened on death, and with the 754 election being in place, is that $60,000 inside basis is going to be increased to the $100,000 because that's the basis passing through from your partnership interest. So you have a basis increase of $40,000. So what the government was concerned about is that if you had the old UBIA of $100,000 plus $40,000 of new inside basis, then you're going to have $140,000 of UBIA. But the property was still worth only $100,000, the original purchase price. You shouldn't be able to count more than $100,000 of UBIA when the value is still the same as what you're getting credit for, still the same $100,000. So what you really should do is, if there's a basis change that changes it from the UBIA amount, then the difference between the new basis and the UBIA amount that's been taken into account, that difference is what should be the new asset for UBIA purposes. And if there's a basis step down, that should also be a reduction in the UBIA. So basically, the government didn't want to deal with this complexity, but AgTech, we went ahead and dealt with it and gave some specific examples. The AICPA in his comments just said, hey, government, you should just do what we say and do the full basis step up. And they didn't really look at the duplication issue. The ABA's tax section did look at the duplication issue and made some very helpful comments on it. So they're kind of in line with what AgTech did. So let's suppose the proposed regulations don't get changed, or let's suppose we're dealing in an environment where we don't know what they're going to say. So, and we're trying to do some planning. And let's suppose you have somebody who's not too long for this world, and they have a partnership interest. Should the partnership maybe distribute out part of the property to them? And then they'll own the property directly. Maybe they'll have a single-member LLC that owns it. So that single-member LLC takes that property and is leasing it to the company. And then when they die, it gets the full basis step up, and it gets the full UBIA. So that could be a solution. And Again, there's the same issues I was concerned about before about equipment leasing and real estate leasing. Let's go on to slide 13. And slide 13, I run through some numbers here to kind of figure out would change in the UBIA and depreciation period help for equipment. So what's the effect before and after the death of a person who leases to a business? So equipment rental is generally a trade or business. If the equipment rental were 20% of UBIA, then the tentative deduction would be 4%. So for example, if the property cost $100,000 and you had $20,000 of rental income every year, so your tentative deduction for your UBI, for your qualified business income would be 20% of the $20,000 rental income. So $20,000 rental income times 20% is $4,000. So your tentative deduction for qualified business income before considering the wage and the UBIA limitations would be $4,000. However, if your UBIA is $100,000 and you don't have any wages because you're just equipment rental, you're just sitting here collecting a rent check, and so you're only looking at the UBIA, so you would be taking the 2.5% limitation of the $100,000 UBIA, so that's a $2,500 cap from the wage or UBIA limitation. So your rental income was $4,000 or 4% of the amount, but that gets lowered down to your $2,500 amount, which is 2.5% of your UBIA. So if you can't aggregate, then this equipment leasing thing may reduce your qualified business income. Another issue is, let's suppose you have used equipment. So you bought it for $100,000. Now, used equipment, it may have significant value inside your business, but from the perspective of resale value, used equipment is usually not worth nearly as much as the original purchase price. It does not go up in value the way that real estate can go. A lot of times it drops precipitously in value. So if you took your used equipment out of the partnership to get a new basis at death, that's actually going to decrease the UBIA because you can have a basis step down at death. So this idea of moving equipment outside of a partnership because of the IRS not respecting the 754 election for UBIA purposes, that's not necessarily a great idea. Going on to slide 14, how about for real estate? So first of all, rental real estate might or might not be a trader business, and we're going to go through that a little bit later. Now, if the rental income were 8% of UBIA, so again, we have a $100,000 building, so the rental income is $8,000 a year. And then let's suppose that you had depreciation. So the depreciation deduction would be, let's suppose it were you were depreciating it over 40 years. So you had a $100,000 piece of property. $100,000 divided by 40 years would be $2,500. So you have $8,000 of rental income minus $2,500 of depreciation, and so that's $5,500 of net income. So I'm ignoring debt here. So debt would make this a worse situation. So anyway, so in this example, your net income is $5,500. So then you take your net income, if it is qualified business income, and you multiply that by 20%. So $5,500 multiplied by 20% gives you a tentative deduction of $1,100. So compare this $1,100 deduction for qualified business income, compare that to the UBIA limitation. So the UBIA limitation is 2.5% by statute. So $100,000 times 2.5% is $2,500. So the $1,100 UBIA, the $1,100 tentative deduction for qualified business income is not capped by the UBIA limitation, because the UBIA limitation is actually higher, $2,500. So you get your full deduction of $1,100. So moving real estate out could help. So it's a lot more likely to help than moving equipment out, but only if the rental real estate can qualify as a trader business, which again we're going to get to. So slide 15. So here are just some strategies about kind of planning it in there. So if you're going to, if you want to try to change the UBIA by doing this 100% ownership, then you want to look at the new value versus the original investment, and if the property is near or passing into the depreciable period, which is the greater of the class life or 10 years from date of purchase, then it would be helpful to restart it. So you want to kind of look at those two components and then figure out whether you want to distribute property out. Now, if the real estate is inside a partnership, you consider distributing separate parcels to each owner. So like, let's suppose that I were in a partnership with Sarah, and each of us owns half of the partnership, and I think that I'm not going to be long for this world, and we have two pieces of real estate. So we might, and then let's suppose they're equal value. So if these pieces of real estate are equal value, then I would, so we're on slide 15, then we would distribute half of the real estate out to me, one parcel out to me, and one parcel out to Sarah. It needs to be 100% ownership by that person. A tenant in common probably would not work, because a tenant in common is often reclassified as a partnership for income tax purposes. So if Sarah and I owned each property as tenants in common, we still might have a partnership for tax purposes, so we haven't accomplished anything by getting it out of the original partnership. We've just formed a new partnership. So you want to distribute each parcel 100% to each owner, and just make sure you don't distort the economics. So slide 16, these are taxable income thresholds I mentioned before. And again, below the threshold, most ineligible service businesses become eligible, which we'll talk about in a little bit, and the wage and UBIA limitations do not apply. Let's go on to the next slide, slide 17. So I mentioned before that each activity needs to be a qualified trader business, and each is tested separately, and there's no guidance on how to delineate. So, basically, Congress said Code Section 162 trader business, and the IRS said basically they channeled the Supreme Court's definition of pornography. I know it when I see it. So we don't know what a trader business is necessarily. You just have to go to common law. The trader business needs to be effectively connected with the U.S. trader business. And my materials talk about that. I thought it was a lot more important than it really is when I originally went through the statute. And the proposed regulations just basically said, it's a U.S. business, then fine. If it's not, then we have issues. So let's go on to the next slide, which is our second code word, which is business, because you have to have a qualified trade or business. So again, keep that for your CLE credit. On to the next slide, slide 18. So each S corporation or partnership is considered to be a relevant pass-through entity. Now, let's suppose you have an LLC. If that LLC is filing a tax return as a partnership, then it's a relevant pass-through entity. If an individual owns an LLC or a trust owns an LLC and is directly reporting that LLC's income on that person's tax return, then that LLC would kind of be like the RPE, relevant pass-through entity. But let's suppose that you have a partnership that owns a bunch of LLCs, so that are disregarded for income tax purposes. Those LLCs would not be RPEs because they're not the ones filing a tax return. The partnership is filing a tax return. So basically, each pass-through entity that files a tax return is an RPE. And each has to separately determine whether it is engaged in one or more trades or businesses. So implicitly, the individual owner does not make this determination. So let's suppose that Sarah and Irene are in a partnership together. So Sarah and Irene are not going to make the decisions as individuals whether the partnership has RPEs. So what's going to happen? The partnership itself is going to determine whether the activity is a trade or business, and because that is the RPE. So each RPE determines not only whether it's a trade or business, but also what the QBI is, and also the W-2 wages and the UBIA of the qualified property for each trade or business. Okay, so what you need to do is you have to tie the W-2 wages to the business. You have to tie the UBIA to the business. And the RPE needs to make that determination. So the RPE is going to issue a K-1 that says, for this trade or business, here was your qualified business income, your W-2 wages, and your UBIA. Go on to slide 19. Aggregation. So, what most people kind of thought was that under the passive loss rules, under Code Section 469, we have rules on grouping activities together. Grouping activities, or aggregating real estate, and those provide an existing framework. So IRS, why don't you just use our existing framework in those passive loss rules, and then you don't have to invent a whole new set of rules. Well, the Treasury said, nope, no can do. We don't like that. There's some differences between the passive loss rules and 199A. We're not going to look to those. We're going to invent our whole brand new set of rules to see whether you can add businesses together. But it is nice that at least they gave us an aggregation rule. I mean, they could have just said each business stands on its own merits. You don't get to combine any attributes. But what they said is that each owner can decide to aggregate the attributes of the various trades or businesses that he or she or it owns. So the ultimate individual, who's the ultimate taxpayer, or the ultimate trust, who's the ultimate taxpayer, will decide whether to aggregate. So we're going to talk about the effect of aggregating and then also whether it's permissible. So on to slide 20. So I mentioned each RPE, again, that's your partnership or S Corp, will separately report QBI, W-2 wages, and UBIA to its owners. So what happens is that each individual will take all these K1s that it gets, or that he or she gets, and will say, okay, these two businesses are closely related, which we're going to talk about in a moment, what qualifies. So I'm going to add their qualified business income together. I'm going to add their wages together, and I am going to add their property together. And I'm going to do all my computations for qualified business income deduction, adding those attributes together. So I have a choice whether or not to do that. And once I do that, it's irrevocable. But all you're doing is you're adding those attributes together. You are not adding together the attribute, the activities in that business. So let me give you an example. Let's suppose that you own real estate directly or indirectly, and that real estate is owned by separate LLCs. And let's suppose that real estate is triple net leases. Now, if you have just one triple net lease that's leased to one tenant, and that's all that entity owns, then that triple net lease is not going to be considered to be a trade or business. Let's suppose you have 20 different triple net leases for your different properties. Those together, and we're still on slide 20, those together might constitute a trade or business. But only if those are under the same RPE, because the RPE decides whether they're a trade or business. So if I own 20 different partnership interests, and each partnership has its own separate triple net lease, I don't get to count all of those together. I don't get to add them up, because I'm not deciding the trade or business. Each separate partnership is going to look only at its own triple net lease and decide whether that's a trade or business. So what you might want to do is if you have a whole bunch of real estate partnerships and they have pretty much the same owners, you might consider combining them all into one partnership that has various single member LLCs that hold those leases. Now, it might be tricky if you have different owners. So that might or may not be a good idea. And I'm not saying that this is a wonderful technique. I'm just saying that the aggregation rules don't let you add those leases together, and this is the only way that you would be able to do that. Whether or not is a worthwhile thing to do, that's for you to think about. Okay, let's go on to slide 21. So when are the businesses possible to be aggregated? When is it permissible? So first of all, the same person or group of persons must directly or indirectly own 50% or more of each trade or business to be aggregated. Now, what does directly or indirectly mean? We're going to get to some family attribution stuff in a moment. We're really going to talk about those tests in a moment. Okay, so they own the same group of person has that common ownership. That ownership exists for the majority of the year. All items aggregated are on returns for the same year. So if they're generally what you're going to do is you're going to have individuals. They're going to be on a calendar year. So all those businesses need to be calendar year taxpayers. If the businesses are on fiscal years, you wouldn't be able to aggregate the fiscal years with the calendar years. Specified service trades or businesses can't be included. There's separate rules for those. And trades or businesses to be aggregated have to satisfy at least 2 or 3 factors, which I'm going to show you in a little bit. Okay, going into slide 22, here's the common ownership. At least 50% of the issued and outstanding shares, at least 50% of the capital or profits in a partnership. You can kind of mix and match different types of entities with each other. And you can see that in the 4th bullet point, the people who count. Absent from that list is siblings. Siblings don't count. But the government, they actually, there were some comments at the hearing that said, well, hey, what about siblings? In fact, ACTEC said, hey, what about siblings? And the government kind of said, well, we really weren't thinking about that when we put the regulation together. So my best guess is that they will add siblings in terms of indirect ownership. But I don't know for sure. Nobody really knows. But we're hoping that they will. How far does it indirectly extend? You know, what if you have tiered ownership? What if you have trust? We don't really know the answers to that. So from planning purposes, we might assume that that's narrow. But for reporting purposes, if we have a tax return, maybe we, when in doubt, interpret in favor of the taxpayer. Okay, let's go on to slide 23. The trades or businesses that need to be aggregated, they have to satisfy at least 2 of the following factors. And you see I have the factors that are listed there on slide 23. And those come straight from the proposed regulations. I'm not going to take the time to go through all of those. Slide 24 goes through examples of whether things were closely enough tied together. And that also, slide 25, does that as well. So my materials kind of tie those together. You can look through all of those at your leisure. I'm not going to get that granular here. I just want to give you the strategy. Okay, on to slide 26. So the statute and the proposed regulations said that if you have compensation for services rendered, such as salary to an S-Corp owner employee, that salary itself is not going to be qualified business income. Now, it can count toward your wage limitations, and that's fine, but it's not the salary itself, the W-2 income itself is not itself going to be QBI. Also, if you have a partner who renders services, you're not allowed to give that partner a W-2. That's a disadvantage of partnerships. And if instead what you do is that's called a guaranteed payment. You might have and the 707C is a guaranteed payment is for services rendered in your capacity as a partner. 707A is a payment for services that a partner renders, but they're not rendering them because they're a partner. They just happen to be rendering them because that's who the partnership chose to do those services. Now, the 707C guaranteed payment, that's knocked out automatically from being qualified business income, but you could restructure it as a preferred profits interest. So suppose all of your service providing partners receive $2 million of guaranteed payments every year. Well, instead of saying they get a flat $2 million, you say they get the first $2 million of profits. So as long as your profits are not in danger of falling below those $2 million, they're not really taking any risk. But by calling it the first $2 million of profits, instead of calling it a flat $2 million, you converted it to a preferred profits interest, and that would qualify. Now, on slide 27, let's elaborate on this issue a little bit more. Consider a company that manages many properties for the owners of the properties. So you might have a real estate management company, and it manages property all over the metropolitan area. Well, that's clearly a trade or business, and that generally would be QBI. Let's suppose, however, as is frequently the case, that company not only manages a real estate partnership, it's also the general partner. Now, all of a sudden, the management fee is going to be considered to be a Code Section 707 payment, and it's not going to qualify as QBI. So that seems to me very unfair. If you're not an owner, you call it as QBI, but if you're an owner, you get penalized. You don't get to qualify it as QBI. Now, the proposed regulation said, if there's anything about the proposed regs in 707 you don't like, give us a shout. We're still thinking through what that should look like. So, in the AgTech comments, I gave the IRS a shout. So here's my take on this, is that the purpose of disallowing these payments is that we don't want somebody who all they did for a business, they did all their work for one business, and they simply got the title of partner, and so somehow they got to count that as QBI when if they'd been an employee they couldn't have qualified it, couldn't have it. And so we don't want the businesses, the partnerships qualified business income to be attributed to them through the guaranteed payment mechanism. I don't think that Congress intended for a partner who was providing services all over the place to get disqualified. They should be able to qualify on their own. I mean, somebody who's providing services for just one entity, that really is a lot more like an employee, it should be fine and knock them out because they can't qualify independently. Being an employee does not qualify as QBI. It's excluded statutorily. So if you're doing all your services for just one partnership as a partner, then yeah, that is not going to count because that's just like getting a substitute for wages. But if you are providing services for a lot of people, then you're not really looking at that partnership's attributes. You're looking at your own level of activity. Your own level of activity rises to the level of trade or business. So I think that Congress did not really notice this issue. They didn't really think about how this would play out with real estate management companies. And I really think that real estate management companies should qualify even if they are partners in partnerships they manage. But there's no authority for that yet. It's just a matter of whether the government is nice enough to agree with my suggestion. And I don't have any legislative history to back me up. It's just my own thought processes. But most people, when I talk to them, say, yeah, what you said makes sense. So I hope that the IRS thinks it makes sense as well. Let's go on to slide 28. As we mentioned before, if you're a specified service trader business, which is abbreviated SSTB here, then you don't get the deduction unless your taxable income is below the thresholds that I already mentioned. And we already mentioned who's blacklisted and who's not. So lawyers, accountants, most of the people on this call, we're providing services to our clients, and we are blacklisted. That's because we are just, scum of the earth. We're evil, and engineers and architects were removed from that blacklist, so they get the deduction, and that's because they're doing God's work. So let's go on and talk about on slide 29. If you are one of these evil businesses and you're above the thresholds, are you going to have to are you going to be able to separate things out or not? So there was a lot of suggestions that talked about break up your business into the good businesses and the evil businesses, and then if the good component is separate, then you can get the deduction for that. So there's a lot of hullabaloo, and there are people who talked about an idea of what they called crack and pack, which being that you crack apart your businesses into the good and evil ones, and then you pack all your good activities into a separate entity. So the government looked at this, it didn't like it, and it said, look, we're gonna be fair to people with just a little bit of evil activity, but people who have a lot of evil activity, they're going to get hosed. Okay, so slide 29. If your trade or business, we're still on 29. If your trade or business has gross receipts of $25 million or less, then if only 10% of your gross receipts are from evil work, then you can disregard that evil work and just count the whole thing as a qualified business. Now, if your business is bigger, then the evil work can be only 5% of it, and you have that disregarded. So if your evil work is greater than the 5 or 10% threshold, then that evil work doesn't get counted into the qualified business income. But if it's below those thresholds, then the evil work gets disregarded. Okay, and I did have a question from somebody about that. They asked, how do you treat a business that has a division that's an SSTB and a division that's a trade or business? Think about it like an eye doctor has a medical practice and a retail eyeglass business. So how do you apply 199A to this? So in this case, you're going to you would basically say that you have two different trades or businesses going on, and so I would separate out my trades or businesses, and then I would say, well, one has QBI and one doesn't, because each trade or business is separately tested. All right, let's go on to slide 30. And so on slide 30, this is going against that crack and pack. So if you have common ownership, 50% or more, between the two entities that own the trade or business, and the trade or business provides too much of its services. I'm sorry, if the SSTB provides too much of its services to the SSTB, then it's an SSTB2. So actually, there's a typo on this slide. In the first sub-bullet point, if the trade or business provides 80% or more of its properties to the SSTB, then the trade or business is an SSTB2. In other words, the trade or business gets treated as being evil. The second bullet point should say 50%. If the trade or business provides 50% or more of its property or services to an SSTB, then the portion providing property or services to the commonly owed SSTB is treated as part of the SSTB. So, example, let's suppose that you have a doctor and they have a surgery center, okay, and the real estate provides all kinds of services. It's a kind of a trader business, okay. If that real estate just has a surgery center in it, and so all that's doing is leasing a surgery center, then that real estate is going to be an SSTB. It'd be an evil business. Let's suppose instead that there was a shopping mall, and there was and 60% of that shopping mall was a surgery center, and the rest of it was something else, like maybe a restaurant. And so while people are waiting for their loved ones in surgery, they can go over to the restaurant, and the restaurant's not owned by their surgery center; it's owned by somebody else potentially. So, that restaurant serves the general public. It doesn't just serve the surgery center. So that restaurant serves the general public, and it's just a cool business. So the surgery center has 60%, the restaurant has the other 40%. So then you would count 60% of this business income, the part that comes from the surgery center, as an evil business. And so that's a specified service trader business. Now, let's suppose that the surgery center was just one of many tenants, and less than half of the rental activity came from the surgery center. Well, then you can count the whole real estate rental as a business. So, and there was an example here from the proposed regulations. So basically, the IRS has gotten rid of this crack and pack idea. So it said to those people, if you did anything to try to take advantage of crack and pack, well, then you were simply on crack. All right, let's go on to slide 31. What is related? And so slide 31 and 32 and 33, those are all slides that explain the related rule from that prior slide. They're just there for your reading pleasure. And we're going on to slide 34. So what items are or are not qualified business income on slide 34? So if you sell a partnership interest and you're selling, and it's part of what you sell is what's called a hot asset. So let's suppose you sell a partnership interest, and you're a cash basis taxpayer, and there's some accounts receivable. Those accounts receivable are an ordinary income type of asset. Those are called hot assets. And when you sell your partnership interest, then the part of the sale price that's attributable to those accounts receivable is going to be counted as ordinary income. Same thing, like if you had equipment and you fully wrote off the equipment, then your portion of the sale price attributable to that equipment is going to be taxed as ordinary income. So those rules go in detail. You can see my reference there in the first bullet point to 2Q8BIF in my materials. And so that tells you what are hot assets. So when you sell your partnership interest, the part of the sale that's ordinary income, that can be qualified business income. But the capital gain part, as we'll see on another slide, is not. You'll also see in there, in the second bullet point, income from a guaranteed payment for the use of capital is not qualified business income. Because notice the earlier slides, they were talking about guaranteed payments for services rendered, which is what the statute said. The proposed regs said guaranteed payment for the use of capital is not qualified business income. The ABA's tax section, in its late submitted comments, they were submitted on October 12th, Comments are due on the 1st. The ABA tax section said, hold on, IRS. I don't think you can really do that. I don't think you can exclude this. And I think that the tax section made some really good points in his comments. So I'm going to let you read the rest of slide 34 on your own. Slide 35. Current year net QBIA losses offset current year QBIA from other activities. So if you have two businesses and one produces a loss and the other one produces income, then that can reduce the amount of QBI. Now, let's suppose that you have one property that is a trade or business, and the other one might not be unless you do take some activity, do some work to it. If the property that's having a loss for the year has a loss for the year, then you don't want that to be QBIA. So you might consider, when you're looking at taking steps to qualify property as a trade or business so you can get counted as qualified business income, is it a loss or is it income? If it's a loss, then hold on, we don't want it to qualify as a trade or business because we don't want that loss to offset qualified business income from other business activities. So I make some other points here about losses, and I mean, generally I think you're going to want to aggregate to try to maximize your deduction, but aggregation doesn't always benefit. I'd say most of the time it does, but not always. You have to run the numbers. So let's go on to slide 36. These items are never qualified business income, and again, capital gain from the sale of your, any kind of capital gain, short-term or long-term, is not qualified business income. Now, what if you sell your S corporation stock? Normally, that's going to be a capital gain, and it will trigger qualified business income. So, I'm sorry, will not trigger qualified business income. It's excluded. It doesn't count. A lot of times, however, when people sell their S Corp stock, they will do an election. Let's look at the third bullet point here. So, in this election, you get to pretend that you sold the S Corp's assets first and then liquidated the S Corp. And they like to do this because the buyer likes to get a stepped-up basis in the depreciable property, so the buyer can take all the depreciation deductions on it. So they like their purchase price to be applied toward getting that depreciation and amortization. So when you have that deemed sale, part of that deemed sale may generate ordinary income. So if you do have one of these elections in place, that may generate ordinary income. And again, just like the partnership with hot assets, this ordinary income can be qualified business income. Okay. Let's go on to the next slide, 37. Dividends are never qualified business income. Interest income may or may not be. Let's go on to slide 38. This was just an example kind of left over from before, and the point of the example is that if you have a partnership in an S corporation, a partnership is not required to pay wages to its partners. So a partner's entitled share of income, if it's all coming from profits, that can be QBI. However, if you have an S corp, then you're required to treat any distributions, any payments made to your owners. Any payments made to the owners have to count as wages to the extent of what reasonable compensation would be. And those wages, as we mentioned before, are not qualified business income. So a partnership has an advantage over an S-corp in that a partnership doesn't have to pay wages to its owners, whereas an S-corp generally does. On the other hand, wages in the S-corp setting will provide wages toward that wage limitation. So that's a benefit. Whereas partnerships, when they make guaranteed payments to their partners, those don't count as wages. They're not qualified. They're the worst of all worlds. They're not qualified business income. They reduce qualified business income because they're a deduction. And they don't count as wages because they're not on a W-2. So there's a trade-off here between S-corps and partnerships. Let's go on to slide 39. Real estate is qualified business income. So I mentioned before about triple net lease often not being a trade or business. Go on to slide 40. You might want to move some of your activity from the tenant over to the landlord to make it look like a trade or business. That's one option. Go on to slide 41. Another option. By the way, at the beginning of slide 41, a proposed regulation assumes that leasing several parcels of land to several suburban airports for parking lots constitute qualified business income. So this raises the possibility that activity might qualify. The regulation doesn't say it always will. The proposed regulation simply says that it might. So that's just a little clue from the proposed regs. That's the only clue they give us as to whether a particular level of rental income may or may not be a qualified trade or business. Then we go into there's a rental exception. There's a self-rental exception. So if the landlord has common ownership with a tenant, then you get to count the rental income as a trade or business, whether or not it's a triple net lease. So you don't have to qualify as a business for being rental as long as you are rented to a commonly controlled trade or business. Let's go on. So that's the end of that segment. I did have a question about why would you ever want to convert capital gain from the sale of S-corp stock into ordinary income using a 338H10 election, and the answer is that the buyers so value the basis step up in the business assets that they're willing to reimburse the extra income tax cost that the seller incurs in having ordinary income. Okay, so on to the next slide, our last code word, because we're migrating over to trust. So our code word is trust. Going on to slide 42. There's no surprises in slide 42. This is the same as we thought before the proposed regs came out. Grantor trusts are disregarded and their items are attributable to the deed owners. When you have a qualified business income and wages in UBIA, you're going to apportion those to the trust and beneficiaries according to the regular portions of distributable net income. For those who are not that familiar with fiduciary income taxation, you can look at a webinar I did back on February 14th, 2018, and get a little bit of knowledge about fiduciary income tax. And that webinar is going to be updated this coming February in 2019 as well. Going on to slide 43. The taxable income thresholds are applied separately at the trust and beneficiaries levels. So when you're checking to see whether you're above or below the taxable income threshold, 157.5 for most taxpayers, 315 for married filing jointly. When you're looking to see whether you're above or below those thresholds, okay, so you apply those thresholds at the trust level for the trust's own retained qualified business income and wages in UBIA, and you look at the beneficiary's own tax return for whether they have taxable income above the threshold for applying the test to the QBI, W-2, and UBIA amounts. Now, one thing that happened was some people have really touted the benefits of trusts. And at one really large institute on estate planning in January, some of the speakers came out and they said, hey, I don't like this $10,000 limitation on the deduction of real estate property taxes. So I am going to take my vacation property and I'm going to put it into 6 different trusts. And those 6 different trusts are going to generate income, and they'll each pay up to $10,000 of real estate tax. And then I'm going to get my deduction for my real estate taxes. So there, government, you are mean in limiting my deduction to $10,000 under tax reform. I'm going to get around that by creating multiple trusts. Now, most people are not going to go out and create a trust that's going to generate $10,000 of income because the tax return fees are tax return prep and tax return fees. It's all a pain in the behind. Who wants to do it? We're not going to go to a lot of trouble just to save a couple $1,000s in taxes. So that example, it got the IRS's ire. It was a pretty exaggerated example. But what happened is that when the IRS heard that example, they said, oh my gosh, people are going to go use trust to get around all these various limitations in the tax law, and they're going to abuse the heck out of trusts. Trusts are evil now. So they instituted several rules in the proposed regs to attack these evil trusts. So first of all, they said that the normal fiduciary income tax, what you're doing is the trust computes its taxable income before considering distributions. That's called this distributable net income. Then, when the trust makes distributions to the beneficiaries, that carries out the income to the beneficiaries. So, let's suppose the trust had $300,000 of income, and it had that cash available, and it distributed half of that to the beneficiary. Well, the trust would have $150,000 taxable income, and the beneficiary would have $150,000 of income. That's totally fair to the tax system. This is the tax law. These are the tax laws that have been in existence from the inception of trust. It's always been this way. Congress has always known that you can shift income between beneficiaries and trusts by making distributions. But, a trustee is going to make distributions only if that's part of the fiduciary responsibility to make distributions. So they're not going to willy-nilly do it. They're going to do it only if that's part of what the trust calls for. So what the proposed regulation said is, we think that's abusive that the beneficiary gets, you're shifting $150,000 to the beneficiary. So we're going to say that we're going to disregard that $150,000 deduction to the trust when we compute the taxable income for purposes of the threshold. So regular income tax purposes, the trust has $150,000 of taxable income. But for purposes of the taxable income threshold, the proposed regs would say it has $300,000. Now, there is zero authority in the statute for this. I think they're wrong, and that's what ACTEC said. And I hope the government comes to its senses and stops violating the statute and longstanding presumptions and longstanding paradigms for fiduciary income taxation. Okay, slide 44. Electing small business trusts. These are the type of non-grantor irrevocable trusts that can own S stock. Some of you know about these, some of you don't. The bottom line is that the government, that normally you compute the tax on the ESBT portion separately from the rest of the trust. The taxable income threshold should also be computed separately, but the government says informally that they're going to mush together the trust's ESBT part and non-ESBT part and treat those as one taxpayer for purposes of determining whether you exceed the taxable income threshold. So again, this is violating what the code says because trusts are evil and they don't like them. So on to slide 45. If you do have property that's in trust and you like the idea that not only does having separate trust make things nicer as a fiduciary and with separate fiduciary duties or separate beneficiaries, and it also provides a side benefit of shifting income. If that does work, you need to think of other aspects of how putting it into a non-grantor trust is going to affect things. So not only are you going to have some of these horrible proposed regs I'm about to tell you about apply, but you also need to consider the effect on the net investment income tax. Slide 45 goes through that. I'm not going to belabor the point. Slide 46. This is I just wanted to point out that trust can't use Code Section 179 to expense the cost of purchases, but you can use bonus depreciation for it. Slide 47. I already kind of mentioned about trust in 2017 law that having multiple trusts could help you have multiple $10,000 limitations for your state and income taxes, and that could be a benefit. And I've also said that these examples kind of trigger the IRS to think that trusts are evil. Now on slide 48, here it comes around full force. The IRS has broad regulatory authority under Code Section 199A to do things to preserve the integrity of 199A. And this proposed regulation I cite on slide 48 says that trusts formed or funded with a significant purpose of receiving a 199A deduction will not be respected for purposes of Section 199A. Well, what does this mean? It's funny, AgTech fellow Mickey Davis said, does this make it into a Rodney Dangerfield trust? It doesn't get any respect. So what does that mean? It's not respected. So informal statements from the government mean that this means that there's no deduction whatsoever. So let's suppose, now, why would you be forming the trust in order to get a 198 deduction? The answer is because you're trying to get within the taxable income thresholds, because the taxable income thresholds let you get a deduction for an evil business, or they also allow you to get a deduction if you don't have enough wages and investment. And so if you can shift your taxable income around, then the idea is that each trust might come under the taxable income threshold, and it could get a deduction that it might not otherwise have gotten. So if a significant purpose is receiving the deduction, that's pretty broad. What's a significant purpose? Well, they kind of define it as, well, you thought about it. And you read an article in the Wall Street Journal. You found out there was an income tax consequence. I think that's very, very broad. It's really putting the burden on the taxpayers to prove that they didn't have any income tax planning involved when they set up their trust. But if I'm a lawyer creating a trust and there's going to be income tax consequences, shouldn't I be advising my client about it? Is the government now telling us that as lawyers, we're not allowed to tell clients what the income tax consequences of the trust are? This is very overreaching. Not only do they say that, but they're saying you're not going to get any deduction. Well, if the purpose of the trust was to try to get around the taxable income threshold, then they ought to say that. What they ought to do is say, if you're trying to do this to avoid taxable income threshold, then you don't get the benefit of the taxable income threshold. Like what if in the first year when you set up your trust, you didn't have many wages and it could really benefit you. But in year 2, you had tons and tons of wages. You got zero benefit from having this in a separate trust because you had tons of wages. Well, then the IRS is saying you don't get any deduction, even though having separate trust didn't benefit for you at all. So that's really overreaching. Slide 49. The multiple trust rule is very confusing. The statute requires that the trust have substantially the same grantor and grantors, and a principal purpose of the trust is the avoidance of income tax. The proposed regulations say, basically, they kind of mirror this. And but then let's go on to slide 50, and what does that principal purpose mean? It says a principal purpose is presumed if it results in a significant income tax benefit. Well, again, here we're going to tax planning. It turns out a principal purpose under the various case law that was in effect when Congress enacted this meant the most important reason for creating the trust or doing the transaction, or that's really what it was. It was creating the transaction, doing the transaction. So the government has basically taken our case law put it on its head and said, the case law says generally you have a principal purpose when you for all these other areas of tax law if the most important reason is taxes. And now the IRS in the proposed regs is saying if any important purpose is taxes. So the proposed regs are being overreaching in that, in our opinion, in ACTEC's opinion, and in a lot of other people's opinion. Now there's some other questions on slide 50. What is the primary beneficiary? Slide 51 and 52. Slide 51 kind of goes into more things. These are really confusing when you go and read the proposed regs. But this is not the government's fault that these are confusing. What happened is when Congress, I shouldn't say the government, it's not the IRS and Treasury's fault. When Congress enacted the code section, it had legislative history that provided certain ideas, certain examples, and those examples are confusing. And the proposed regs simply implemented those ideas. But those ideas, Congress did not think through things all the way, and Treasury mirroring it didn't do so either. And so, and they were in a hurry to put out these rules because of all the effective dates. And so I just think they just kind of didn't elaborate on this. So we'll see what happens. ACTEC has some comments about some reasonable rules that they might want to consider. Slide 52, effective date. There's some confusion there. Slide 53, what's the effect of collapsing trusts? If you have suppose you created 5 trusts a decade ago, at the time when creating separate trusts didn't provide any income tax benefit at all. And then, lo and behold, in 2018, mom and dad create a sprinkle trust for the benefit of all 5 of the children. Some people will say a pot trust, but I'm not going to specify that cannabis was in there. So anyway, so now you have this extra trust that had an evil motive that benefits everybody. Does that mean that all 6 trusts are now aggregated? That would not seem fair, but we don't really have guidance on it. Okay, slide 54, slides 54 and 55, kind of going on toward the rest of it. These are all going through various considerations that were not affected by the proposed regulations. Let's go into slide 61. slide 61 is a structure I like to use, but I am concerned about whether the leased employees are going to be, if there's a management fee being paid from the limited partnership. This is slide 61. So on slide 61, I'm concerned about, normally what I have here is a limited partnership will pay a management fee to the corporation, and then the corporation would pay the salaries. I'm kind of concerned about whether that would meet the leased employee exception. I'm also concerned about whether you'd be able to count the wages if it didn't meet the leased employee's exception. That's not in these current materials I sent out to you, but if you're concerned about that issue, email me for the most recent version of my materials, and you will see in there I have something that addresses that. I had one more question from somebody, which was, would leased employees include temps who are used on a regular basis? And the question is, are those temps people who are considered to be common law employees in terms of the type of supervision? I don't really know the answer necessarily. I think you need to go and take a quick look at the proposed regulations that provide this exception and look to see literally what the test is, and then literally apply your facts and circumstances, and then do your best judgment in applying your facts and circumstances to it. So let's go on to slide 62. So in conclusion, the February 4th, I mentioned about fiduciary income tax. There's information about that. I'll have a July 29th webinar for my fourth quarter newsletter. Encourage people who are not already subscribers to subscribe to my blog. I also have reports from the Heckerling Institute on estate planning that come out in January, and so you can subscribe to those. So that's everything from there. Again, feel free to email me for my full version of my materials to get in that leased employee information. So thank you for participating in the webinar. As a reminder, please complete and submit the course evaluation that is available in the widget at the bottom of your screen. Thank you very much.